Assalamualaikum warahmatullahi wabarakatuh. My name is Amelia Rahmadhani Putri Amrigan. In this lovely occasion, I would like to present my paper to you about the importance of efficient contracting approach to good corporate governance in decision usefulness. So, let me start it. Introduction. Today's business world is becoming increasingly dynamic. Changes ups and downs are commonplace when running a business, even for the future. Departing from the increasingly dynamic business world, a company is required to have good governance, or what is commonly called that good corporate governance. The basic principles of good corporate governance arise as a result of the relationship between three important pillars. They are the state and its instruments as regulators, the business world as a provider of goods and services as well as market players, and the community as user of goods and services and as the party affected by the access can then show concern and exercise control objectively. And this relationship between three pillars is expected to create a conducive business and market situation and have a sustainable long-term aspects. The effort to implement good corporate governance practice is one of the important steps that the company considers to be able to increase company value, apart from encouraging professional, transparent, and efficiency management. And the company believes that the implementation of good corporate governance practice can fulfill its obligation completely both to shareholder and to business partner and all stakeholder and society as well as consumer is in general. And this implementation of good corporate governance is expected to increase the company's performance and added value, because the increasing company performance has an impact on the welfare of company management and shareholders. And on other hand, the management has the potential to take action through the selection of accounting policies that have a positive impact on their own interests, and it is very possible that what management does will have a negative impact on the interests of company owners. So the efficient contract are very significant aspect of company management or good corporate governance, because to strengthen a corporate governance, contract must be made as efficient as possible. They must be optimally balanced between cost and benefit. So, the aim of this theory is to understand, predict, and determine the choice of managerial accounting policies in different situations and different firms, and how financial accounting can contribute to efficient contract management. And in this paper, we will discuss that how efficient contract can help good corporate governance. The formulation of the problem are the definition of good corporate governance and a definition of efficient contracting theory, and how important is efficient contracting theory for good corporate governance, and the objective of this paper is the recognizing the importance of efficient contracts for good corporate governance. The discussion. A. The good corporate governance. What is the good corporate governance? The good corporate governance are the principles that underlie a company management process and mechanism based on laws and regulations and business ethics. The application of good corporate governance principle can improve company performance and long-term economic value for investor and stakeholder. The example of good corporate governance implementation are internal control and supervision system, reporting mechanism for suspected irregularities, information technology governance, ethical code of conduct, and etc. And to be considered that the company with good corporate corporate governance, there are several main principles that need to be considered. The principles are: the first is transparency. The transparency is the disclosure of sufficient, accurate, and timely information to stakeholders. There are at least two virtues of transparency in good corporate governance. The first is transparency will hold the directors and company boards accountable for any decision and mistake they make. And the second are transparency will strengthen shareholder confidence in the company, both in terms of company management and investment return that will be better. The second is accountability. Accountability is the clarity of function, the implementation and responsibilities of the company so that management is carried out effectively. The principle of accountability provides clarity of right and obligation between shareholder, the board of director, and the board of commissioner. The third is responsibility. The accountability is conformity of company management to the rules and principle of health corporation. Example of the principle of responsibility are worker safety, worker health, tax, and etc. The fourth is independency. Independence is the professional management of a company without conflict of interest and influence from any party that is not in accordance with the law and sound corporate principle. The last is the fairness. Fairness is the fairness and equality in fulfilling the right and stakeholder that arise from the agreement and statutory regulation. The example of fairness is equal treatment to the public, capital market authorities, the capital market community, and stakeholder. And the employees are also paid attention to the right and obligation fairly and fairly. B. Efficient contracting theory. What is efficient contracting theory? Efficient contracting theory studies the role of financial accounting information in moderating information asymmetry between contracting parties, thereby contributing to efficient contracting and supervision and efficient corporate governance. Information asymmetry arises in contracting because management has inside information about the state of the company and it may not be necessary to share this with other contracting parties. If they share, be able to elder or exaggerate information. In addition, the management effort to operate the company cannot be directly observed by outsiders. And in this both case, the outside contracting parties seek accounting information to help protect themselves from exploitation. So from this, we can say that the efficient contracting is a significant component of efficient corporate governance. C. The important efficient contracting approach for good corporate governance. The corporate governance is a policy that aligns company activities with the interests of investor and society. Efficient contracting is an essential component of this alignment. The company signed many contracts such as with customers, suppliers, management, other employees, and lenders. And for good corporate governance, this contract must be efficient, where they must achieve the optimal trade-off between contract benefits and costs. And this contract is relevant to financial accounting because the important contract depend on accounting variables. Like the payable contracts contain accounting-based agreement, and thus a debt contract can contain covenants such as maintaining a certain level of working capital, not exceeding a specified debt-equity ratio, or maintaining an agreed-upon interest-income ratio. In addition, bonuses paid under managerial compensation contract usually depend on net income, either directly or indirectly through the effect of reported earning on the share price, and this type contract tends to be long-term. The accounting standard change frequently during contract condition, which affect this net income and debt agreement, and this result in likelihood of violating the debt agreement rising and the manager compensation to be affected, The contracts are difficult to change, but inevitably must be renegotiated to accommodate change in GAAP. Therefore, the managers pay attention to change in accounting standard and policies. Efficient contracting theory assumes that managers like investors are rational, and efficient contracting help explain what accountants know important accounting policies for managers. As a result, manager cannot be considered to be maximizing firm profit and more generally acting in the interest of investor. On the other hand, they will only do so if they consider the behavior to be in their own interest. As a result, the interests of manager, lender, and shareholder are at odds. Efficient contract theory studies how these conflicts are resolved, and it also predicts how managers will react to new accounting standards. It helps us to understand why managers often reject new standards, and through better understanding, it allows us to appreciate how efficient contract design can help align manager interests with that of givers, loan, and shareholders. A new accounting standard will have economic consequences if the new standard can motivate managers to adopt accounting policies or operating policies. The efficient contracting help explain what accountants know, important accounting policies for manager. From this, Dichev and Skinner 2002 support this argument that accounting policies are important. For each sample firm, the Dichev and Skinner calculate the covenant slack for each quarter while the loan is still running. DS found in their sample that the number of quarters with zero or little positive allowance was significantly greater than would be expected if the firm had not managed their covenant ratio. And the number of quarters where the allowance was slightly negative was significantly smaller than expected. And these results are consistent with the economic consequences argument because they suggest that managers choose accounting policies to maintain their covenant ratio so that they meet or exceed the required level. And Dichev and Skinner also found that the tendency to maintain zero or positive slack was very strong for the quarter leading up to and including first covenant violation. They show that the cost of an initial breach is higher than of subsequent offenses because the lender will immediately take action to protect his interests, and much of the damage to manager and this company reputation occurs when the first breach occurs. So managers work very hard to manage covenant ratio to avoid early breach. And this finding also support the assumption before that managers are rational. And this theory also envisaged an implicit contract which arises from an ongoing business relationship. The example, if a company builds and maintains a reputation for high-quality financial reporting, it's earned customer, creditor, and investor confidence that the company will continue to operate with integrity. So, as the result, the company may be able to charge a higher price for the product and enjoy lower borrowing costs and capital costs. The initial investigation of implicit contract was carried out by Bone, Ducharme, and Schurz in 1995, where they argued that the company reputation can be supported by high reported earnings, which increase stakeholder confidence that manager will continue to fulfill contractual obligation. Based on a large sample of U.S. companies over the period in 1981 until 1993, the Bowen, Ducharme, and Schurz found that companies with high level of ongoing engagement with stakeholders were more likely to prefer FIFO and straight line amortization policies than firms with lower level of ongoing involvement. Consistent with their prediction, FIFO and straight line amortization are considered a revenue increase because they tend to produce higher reported earning over time than LIFO and its accelerated amortization counterparts. The Graham, Harvey, and Raj Gopal in 2005, in a post-enron survey of a chief financial officer of U.S. public companies, support that the finding of the BDS before. They report that manager-rank relationship with other stakeholders as important reason for meeting profit target. The importance of implicit contract was also highlighted during the event leading up to the 2007 until 2008 market crash. And the new and Richardson in 2006 report the evidence that the market value company share as if the income from off balance sheet ABS issued by the company is a liability rather than asset. The main reason for this finding, they argue, is the prevalence of implicit collateral in which the issuing company feels they have an obligation to bail investor in securities assets that lose value, thereby enhancing the reputation. So the efficient contracting theory believe in the market, and it confirmed that ideally the demand for financial accounting information should be met by market force, with a standard setting rule providing general principle on which accounting practice can develop under the law of supply and demand. And the several sources of information, the addition to appropriate financial report are available to meet the demand for market information. So from that we can get the conclusion that the company can be said to be a company with good corporate governance if it has the following principle. There are transparency, accountability, responsibility, independency, and fairness. And the application of good corporate governance principle can improve the company performance and long-term economic value for investor and stakeholder. And the efficient contracting is an important component of good corporate governance that as a policy that align company activities with the interests of investor and society. And this contracting is relevant to financial accounting because important contracts depend on accounting variable. And the efficient contract theory assumes that manager like investor are rational, where this put the interests of manager, lender, and shareholder at odds. And the efficient contract theory studies how these conflicts are resolved and can help align manager interests with lender and shareholder. Then this theory also envisages an implicit contract which arises from an ongoing business relationship. Therefore, the efficient contract approach is important for companies in align all activities that occur in the company with the interests of investor and society, and it is an important component in good corporate governance. So it can give the explanation to us why or how the efficient contract theory is important to the good corporate governance in decision usefulness. Okay, that's all from me, and thank you.